Joining me now, Ryan Detrick, Chief Market Strategist at Carson Group. Ryan, thanks so much for being here.
Caroline, thanks for having me.
So Ryan, stocks are lower today, but the S&P 500 hit a new all-time high last week. How sustainable is this momentum heading into 2026?
Well, again, thanks for having me back. Thanks for having me, I guess I should say, for the first time in a while. We think there's a lot of momentum. And listen, the S&P 500, the time we're doing this, is up 7 months in a row. We might be up in December, so that's 8 months in a row. So we know this is a fairly stretched, big picture market. But I think what's so encouraging as we look around the globe, it's not just a U.S. story, right? There's a lot of other countries that are participating. We've advanced decline lines making new highs. Tech pulls back a little bit. So industrials and financials take the baton. The lifeblood of a bull market is passing that baton around. So eventually, we're going to have a down month or two. I mean, that's just how it works. But big picture, I think there's a lot of strength to this bull market, and this bull market is really alive and well.
So what is it that has you optimistic that this is a bull market that's going to charge on?
Yeah, there's a couple things. I guess the two that really stand out, we call these the dual tailwinds to a bull market: earnings and profit margins. Right? We just had a spectacular earnings season that wrapped up, and we're looking at, according to FactSet data, like new highs in profit margins as well. So if you have those two dual tailwinds, we've been talking about this for about 3 years now on the Carson team. That tends to suggest you're still in a bull market. And one more thing about this, this bull market here in the U.S., it just turned 3 years old a couple of months ago in October, right? So it's in its 4th year is probably a different way to put that. Going back the last 50 years, we found 5 other bull markets that made it to at least this point. And I say bull markets like a cruise ship. Once they get moving, they're hard to slow down, they're hard to turn around, and they're hard to stop. And sure enough, looking at those other bull markets, the average length was 8 years. The shortest any of them went was 5 years. This is just one way to put it. But I think this momentum is real, and this bull market probably has a few more tricks up his sleeve as we head into 2026.
Do you have a price target for 2026? How much further can stocks go from here?
Now we do with our 2026 outlook. We're saying the S&P 500, we go by percentages, will gain between 12 and 15% in next year in 2026. And you think about it, the average year, right? The average year gains about 9%. What's fascinating, I think, for investors to really remember, especially this time of year, only 4 times going back since 1950, so that's 75 years, has the S&P 500 gained between 8 and 10%, okay? Only 4 times. That's about average. What's that tell us? Well, bigger moves are more normal. When you're up, it's up about 19% on average versus when you're down about 14. Now, layer on one more time with this, we do not see a recession. Again, we think things are going to be pretty good. Reacceleration globally next year is a big theme of ours. In years you don't see a recession, the S&P 500 is up at least double digits 7 out of 10 times. So again, yes, we're looking at 3 spectacular years in a row. That doesn't mean, though, that this 4th year can't be solid. We probably don't gain 20%. But you know what? 12 to 15%, we think makes a lot of sense in 2026.
Yeah, and still double-digit returns. I guess the next question would be, what role will big tech play in that 12 to 15% returns? Do you think we'll see this rotation out of tech in the new year, or will it lead the gains?
Caroline, we think tech will still be part of the gains, right? And what's so fascinating about this year, like there's the Mag 7, we all know that, and the 493. When you look at the Mag 7, like I can't really talk too much individual equities, but only 2 of them are outperforming the S&P 500 this year, right? It's not all about tech. And again, I kind of hinted a couple questions ago. Tech didn't do as well in November and December. That's okay because industrials, financials kind of took on. One of our big themes, again, in 2026 is we're calling it ride the wave, right? There's a lot of momentum. There's a lot of positive things that are coming out there. We think riding the wave of cyclicals makes a lot of sense. So that's your industrials, your financials, and your technology. Let me be clear. We manage almost $7 billion on the Carson Investor Research team for our financial advisors. We are even weight technology. That doesn't mean we're wildly overweight. Doesn't mean we're underweight. You need to have tech exposure. We still think in this bull market that we're in. But again, I think there's going to be some better opportunities. And one of them, jumping around. I mean, the globe. I mean, around the globe, we finally saw that Europe's up like 40% for the year. All right, like almost 20% better than what the U.S. is doing. You got to go back like 19 or 20 years the last time we saw something like that. The big question everybody has, if you manage real money, will that continue? Well, will the rest of the world keep doing really strongly relative to the U.S.? We think it could. We think it absolutely could. And you think about Europe. Last comment on this. What's really in Europe? Financials, industrials, materials. There's not a lot of technology. There's some, but not a lot. So from a diversified portfolio point of view, we're overweight equities. We have a big chunk of U.S. We think having some developed international, maybe a little bit even a tad overweight developed international, makes a lot of sense. That's one way to play kind of the world without Mag 7 by having that developed international in there.
But if you think U.S. markets are up 12 to 15% in 2026, do you think that Europe will actually outperform that?
Yeah. We've had some internal discussions on this, and we think there's a chance, right? You're telling with Jim Carrey, right? Lloyd Christmas. You're telling me there's a chance. We do think there's a chance of that. Now, again, that doesn't mean you shouldn't invest in U.S. There's going to be pockets of U.S. that do better, but just from that, one way to put this, the German DAX, right? Very important stock market, German DAX. Just earlier this year, broke out above levels it was trading at back in 2007. You're talking like 17, 18 years ago. That to us suggests, again, this breakout is real and this reacceleration around the globe is real. So, I wouldn't be shocked if some various countries in Europe did better than the United States next year. But again, that doesn't mean the U.S. won't do well. And we still have a lot of U.S. exposure, to be very, very clear. But I think it'll pay, much like it did this year, it'll pay next year to have that globally diversified portfolio as other parts of the globe do really well next year also.
So you're saying there's a chance, not lost on me. Also breaking out to new highs, although pulling back a bit today, gold and silver. What does that tell you about investor sentiment heading into the new year?
Well, a great question there. I mean, just earlier today or just last Friday, you're talking gold up 70% for the year and silver up like 170% on the year. So without saying, and it's not too obvious, that rubber band was extremely stretched. It's not a surprise to us that's snapping back today. Maybe we see a little more of that. But big picture, what does it mean? So many people have been wondering, is higher gold a bearish signal for the stock market? Is stronger silver a bearish signal for the stock market? We say no. Right, we were one of the very few places back in 2023 when the regional bank crisis started. We added a little bit of gold to our portfolios, the models we run, and we said, again, we were one of the few that said this, we might have a period of years where gold and the stock market go higher together. Because we've seen it before, right? There have been periods of 5 or 6 years in a row where both go higher together. We're looking at year 3 of both higher together. And then I look at things like industrial metals. You've got copper, aluminum, steel. Obviously, silver has some industrial components to it with the AI and things like that. Those, to me, it's hard to get bearish the global economy when you have something like copper breaking out, aluminum breaking out. Those are positive. The one commodity clearly that's lagged this year is crude oil, right? Crude oil, and it's popping a little today, but at the same time, I think crude oil might play more catch up next year. So I don't expect gold to be up another 70% next year, but we will say we still have some gold in our portfolios, and having some of those commodities, metals and mining in a well-diversified portfolio still makes sense. And last comment, in bull markets, you want to buy things that are having scary pullbacks. Well, gold's had multiple scary pullbacks the last couple of years. It very well could be in the midst of another one. So kind of let the prices come to you. And if someone missed some of this gold bull market that I don't think is over yet, or we still think there's some juice left, this might be an opportunity to add a little bit more on the cheap versus where it was a week ago and everybody loved it.
Bitcoin's had a 30% pullback from the highs. Would you buy that?
No, we're more neutral on Bitcoin. I mean, we don't technically have a view on it. I will say in some of our more aggressive tactical short-term models, we do have a little bit of Bitcoin in there. But big picture, I think it's very important to understand who the investor is when it comes to Bitcoin. Obviously, someone younger, makes sense to have a little bit more Bitcoin. Someone a little bit older, maybe not, because like you said, it can go down 30%, it can go down 20% in a weekend. I will just say, plain and simple, from the Bitcoin risk on, risk off scenario. Obviously, Bitcoin's actually hanging in there today, right? The Bitcoin's hanging in there today. Market's down. So if we start to see a little bit more strength out of Bitcoin, that's just another probably signal that the bulls are back in control. But when it comes to Bitcoin, we're not huge Bitcoin bulls, I guess I'd say. We've been more in the commodity space, which obviously has been actually better this year.
Okay, so finally, as we wrap up, if someone's been on the sidelines this year, maybe Liberation Day scared them, maybe they didn't expect that to be the bottom, what's your message to them as we head into the new year? What do they do now?
Great point. So I think, as we think about 2026, just know that every single year is going to have scary headlines. Every single year is going to have volatility. One of the things, obviously, with Liberation Day down 10.5% in 2 days, we talked about it at the time back in March and April. Even some of the best years ever have had big down days. There was a day, I think it was August of 97, down 6% in 1 day in 97, summer 97. And then still gain 30% on the year. So again, plans are useless, but planning is everything. President Eisenhower, for investors out there, plan for volatility, plan for weakness. Another cliche one I like to use is the stock market's the only place where things go on sale and everyone runs out of their store screaming, right? So there's going to be a sale at some point. Things are going to pull back. Do not use it as an opportunity to panic. Use an opportunity to follow your investment plan. And again, likely suggesting this bull market has a good deal. I know it sometimes makes people angry when I say this, but it probably has a good deal of life left to it, especially, last comment on this, when you consider we have inflation that's kind of, a little hot, but not wildly hot. You have a dovish Fed. You have a global economies that are starting to reaccelerate, being led by earnings and corporate profits. The last 22 times the Fed cut interest rates near an all-time high, the stock market was higher a year later. 22 times. The Fed just cut interest rates a couple weeks ago near all-time highs. The old saying, don't fight the Fed. That's something I think investors need to remember when we have the inevitable 5 to 10 to maybe even 15% peak to trough correction at some point during 2026. The drivers that got us here are still in play, in our opinion.
Okay, so just finally, for those investors, if they are on the sidelines, stay on the sidelines and wait for the pullback, or get in now?
No, this is a great question there. I always like to say dollar cost average. That way you don't get too cute with it. Maybe every 6 weeks or so, put a third in, because everybody says if you go in now, then you have the pullback. You get sick to your stomach, or vice versa. But again, do it if you are constructing a portfolio right now. Have that globally diversified portfolio. Don't just go all in on any particular sector, like Mag 7's what everybody looks at, obviously. But look at some other areas. I mean, who in their right mind would have thought utilities the last couple of years would have done as well as they've done? They're not your grandfather's utility anymore. So again, have a diversified portfolio. Continue to use the pullbacks as an opportunity. And if you really have missed this whole thing and you have a bunch of cash in there, I like to say dollar cost average. Maybe do a third every 6 weeks or so, and then you'll be in the market by springtime or so. When it warms up, out there, and I think you'll still benefit from this bull market.
All right, we'll leave it there. Ryan Detrick, Chief Market Strategist at Carson Group. Really appreciate your insights. Thanks so much.
Thank you, Caroline. Appreciate it.